Today's market call is presented by CME Group, where risk meets opportunity, and FactSet, financial data and analytics powered by tomorrow. It's a warm Wednesday, June 11th, back at 11 a.m. today. Thank you, Bill Hochman. 8 a.m. on the West Coast. Guy Adami, Dan Nathan. Dan, if it's Wednesday, yes, it's Butters. You got to be fast, Dan. It's like
you're on. You're just on.
I'm always on. How are you? By the way, we've been together now on this Zoom call for a while. We've been chatting about other things, getting prepared for today's show. But as I mentioned, Butters on a Wednesday. The two of us, market continues to hum.
Yeah. Well, I think the thing that sticks out to me, and this is, it makes me feel a little bit better about the rally, okay, that we've had over the last couple months or so. The fact that we did not see the futures up 1% pre-opening, do you know what I'm saying, off of like this headline about a trade deal, because I think you and I know, and anyone who really actually wants to be honest about this, who follows this stuff on a day-to-day basis, that this is not a trade deal, especially if you think about it in context of where we were on April 1st. Yeah, you know what I mean? And all the mayhem that ensued over the next, few weeks or so. And the fact that, the VIX stayed elevated for a long period of time, despite the worst being out of the way, I feel like by the time we got to late April, that sort of thing. But now it just feels like, okay, we can actually put away all that trade bullshit that went on for the last, few months or so. And now we can refocus on some of the stuff that, a lot of, pro-growth agenda, this and that, our tax and, all that sort of stuff. So, to me, the fact that we didn't overreact to the upside on this headline is actually encouraging to me. You know what I mean? Because that would have gotten us into like silly time if we were just breaking out to new all-time highs.
No, I understand what you're saying. That's fair. And at one point today, the S&P was negative, and obviously there's a lot of time left in the day. So we will see if this is sort of a buy the rumor, sell the news. But one thing we've talked about now for the last month or so, and we've had conversations around it, are people like Stan Druckenmiller, Steve Cohen, Paul Tudor Jones, their concerns. And we said that all these people reserve the right to sort of change their mind. And we said we didn't know if they changed their mind because we haven't heard from them. Well, we heard from Paul Tudor Jones today on Bloomberg, and I watched the majority of that interview before I had to do something else. And all the things that he was concerned about on CNBC a month or so ago, he was concerned about today. And, he talked about the stock market, and he talked about some of the worries that he has. He also, like Jamie Dimon, is absolutely concerned. You could see another bit of a kerfluffle, a word that I used yesterday, I'll use again today, in the bond market. Now, the market shows no inclination for that to happen. It does not have any, concern right now, but it doesn't mean those concerns are unfounded.
Yeah, I think that if you talk about the bond market, I think Jamie was also, and I'll just call him Jamie, what he was crying about a little bit was just the lack of concern, I think, about pockets of risk that it relates in the private credit market, right? And so the knock-on effects could be far and wide if you started to see some sort of default rate or some sort of financial institution that is regulated starting to take a hit from some of their exposure to an unregulated, right, pool of credit, that sort of thing. And I think the fact that most people seem to be, pretty laid back about this pocket of risk that's been bubbling up, I think that's a bit of an issue. But if you're just thinking about this right now, and I'm just looking at my main FactSet screen here, I got a VIX at 16.4. I got an S&P that's up 30 basis points at, 60.58 or something like that. The all-time highs was 61.50. I see a 10-year treasury yield on a day that we had, CPI data, it's down 3 basis points. You know what I mean? Like, there just doesn't seem to be any alarm bells going off anywhere, which I think is a good thing. I mean, I don't know about you, man, but like, I was not feeling particularly comfortable when we had that sort of early April into mid-April sort of meltdown when you see all these disconnects. At one point you saw, obviously the stock market careening lower, the US dollar careening lower, treasury bonds, careening lower. And there was just kind of reason to be alarmed. So now like let's play it out a couple months ahead of time. And we just went through everything that seems pretty calm. I'm glad that Paul Tudor Jones is not turning tail, you know what I mean? And saying, all right, well, I was wrong, because that would be, to me, like intellectually dishonest. Of all those folks, these billionaires who actually have a beat on all of this, and they have for 30 some years in the markets, if they're just going to be like as whimsical as some of the folks on Twitter, you know what I mean, about what's going on, then we're kind of in a bad spot. Then you should probably turn the channel and start finding some other folks to listen to about markets.
Yeah, well, they don't blow hot and cold with the market, to your point. And again, nothing's really changed other than the fact that the S&P 500 is going from 4,700 and change basically to 6,100. I'm giving it the benefit of the doubt here. And that's happened in a historic amount of time. Very few days for us to have this type of move. So it's clearly, say what you want. I mean, and I can push against this all I want, but it's clearly a bit of a V reversal. But let's take a look at the first chart in terms of the S&P minis and the futures, because for you Top Gun fans out there, we're about to sort of get into this danger zone. Has been highlighted by these two horizontal lines. And, you know, that gets us right back into levels that we obviously failed at, or stopped at. I shouldn't say failed at, stopped at back in February. So the question that I think everyone has to ask, what happens now? Do we go ratcheting through it and just sort of build on a multiple that's already expensive? Or do we get some exhaustion here? And I think we know where I stand, but obviously the market's the ultimate arbiter of this entire thing.
Yeah, I think coming into the year, before, like, you know, the inauguration, and before we are going to kind of get the level of trade tariffs, or trade, you know, I guess, you know, whatever you want to call it. We're going to have the export restrictions, and then we're going to put huge tariffs on not just, you know, China, but also our biggest trading partners who are our allies. You know, the market seemed like it was prepared to keep humming, right? We had 2 consecutive years in the S&P 500 of 25% gains. We had this massive secular shift going on as it relates to CapEx for generative AI. And a lot of folks thought there was no reason that should get derailed. Most of the strategists coming into the year were optimistic about tax reform, about deregulation, right? About a more level playing fields as it relates to trade. And all those things meant to be like tailwinds for the economy and the markets. And that changed really quickly. So here we are now, we're back at the levels where a lot of folks felt really good about a lot of things going forward, right? And so that's what I think you use the term danger zone, because if we do fail here and we do start getting like a bit more or less optimistic about what the other side of a trade deal looks like, then you start to question valuations. Then you start questioning a little bit of the health of the consumer, and, you know, what it means for companies that have actually already made, maybe the trade stuff guy gave them a mulligan in a way.
Mm-hmm.
Maybe it gave them the opportunity to kind of reset expectations a little bit. And, you know, I know we're going to get to Butters in a little bit, but, you know, some of the stuff that he had been tracking throughout that Q1 earnings season, you know, about like companies that were pulling guidance, or, you know what I mean, like are using, you know, some sort, we were shocked how few, you know what I mean, were doing that, right? So maybe as you get further into like the end, or we're almost at the end of Q2 here, maybe you start hearing a bit more from companies as we get into July, that things are slowing down, right?
No, I think that's fair. I think you make a good point. And I was surprised. I know we said it at the time about how the lack of concern in terms of guidance from a lot of these companies. But, you know, I think you make a good point. There's obviously this period of time has allowed for a bit of a reset, and maybe on the corporate side of things, that's good. But there's no denying the fact, you can't get around the fact that the concerns that are out there have not gone away. And those concerns around valuation, which is clearly just getting more expensive, the concerns around a consumer that's clearly, in my opinion, strapped. And I say that through the lens of these delinquency rates continue to go higher. And potentially, you know, a labor market, although it seems strong right now, I mean, we've seen signs around the edges that could start to deteriorate as well. So we will see. I'll say this as well. You know, if you look at the NASDAQ futures, you know, it's telling the same type of story, but, you know, maybe it looks a little bit better here. I mean, it's a very similar chart. Let's put it that way. And as you know, Dan, as you bring up all the time, I mean, this is built on 8 to 10 stocks that we seemingly talk about ad nauseum. I'll say this, though, that NVIDIA at this 143.5 level, you know, we're right back where we were post earnings, and it doesn't seem to want to do all that much. So we'll see how that plays out.
Yeah, and looking at the NASDAQ futures here, you know, that high, that intraday high, we're going back to like February 18th was somewhere, I'm just looking at 22,139-ish or something like that. So let's just call it 22,140. And, here we are at 22,063. I mean, listen, I guess the thing is, what is the gusto? What is going to be the thrust, right, to get through those prior highs and then have a bit of a runaway breakout? I mean, you can do the math right here. I mean, the low was 16,460 or something like that on April. So here we are, we're up. Oh man, the S&P was up like 25% off the lows. The NASDAQ futures are up 34%, right? So to have that sort of ricochet back to the prior highs, and then to think about what that move is if you break out, look at that double top that we saw from, kind of December into, that kind of late February period. I would expect you see a bit of a back and fill. You see that 200-day moving average down there, 20,000, what is it, like 900-ish or something like that. I just don't know what gets the market, at least the NASDAQ, breaking out, especially when we just had NVIDIA, we just had Broadcom, we have Oracle Knight, we have Adobe. And I think those are just a bit signaling in a way of like where like some of the biggest themes in tech are going. And I just don't see them reaccelerating because we have a supposed trade deal with China. Maybe it's good for NVIDIA that if some of these export restrictions are kind of pulled back a little bit for their chips, but I don't really see it that much broader than that.
Yeah, listen, it's a perfect question to ask, given that we just looked at two charts. NJTech.net is asking triple Qs or the VOO. I think the VOO is like a Vanguard. It's basically the S&P 500. I think it's a Vanguard property. But this is a coin flip to me. If I had to guess, my instincts would be you're more the QQQ guy. But, you're flipping a coin right here because they look eerily similar, as we just pointed out.
Yeah, I think it comes down to what sort of concentration you want, right? So if we talk about those top 8 or 9 names, in the S&P, they make up 30% of the weight. In the NASDAQ 100, they make up, nearly 50% of the weight. And so my view here is this: it depends whether you're an investor or a trader, right? If you're a trader and you're looking at this NASDAQ and you're looking at it through the lens of the futures and you're saying to yourself, okay, I think that maybe this is enough of a retest back to that prior double top. You basically could go back and you'd say, all right, so I'm looking at, this prior high. We just kind of gave the levels. If you wanted to take a shot, you wanted to play for a move back towards that 20,900 level, then you would kind of stop on the short side, the futures right really close to those prior all-time highs. Maybe they kiss it, maybe they get through, but really what is going to be the thing, as we just described, that's going to cause it to kind of break out and continue to go? I'm not so sure, but if you're trying to play it really kind of close to the vest, then you put a stop right above those prior all-time highs. And I would even look at that February high, if you will, and then you're playing for a move, so if you're saying you're stopping at 22,100 or something like that, and you're playing for a move that's a little higher than that, back to 20,000, 700 or something like that, that's not a bad risk reward, especially if you're using a stop. And then you want to continue to kind of probe those levels. Let's see how it acts when we get to those prior high.
Well, you know exactly where your out is if you're wrong. So I think that's a good point. What appears to be breaking out, though, is crude oil. We have a static chart for you T-shirt fans out there. So let's take a look at it because, very quietly, this has gotten itself off the mat. Now, maybe it's on the back of this trade deal that's just been announced, and maybe there's some relief rally going on, thinking that, okay, it's not going to be as sort of draconian as we thought. So here's the chart. I don't know, again, if we've broken out or we're just at this trend line. I guess the real test, Dan, will come if and when we get to the 200-day moving average, which I think is around 68.5 or thereabouts. So we'll see. But it's clear, at least in the short term, that you're seeing this pretty meaningful bounce in the crude oil market.
Yeah, and we kind of highlighted these levels, the breakdown level about 65, going back to early April. And I think the concern there obviously was that if we have a protracted trade war, you're going to have lower growth, you're going to have lower demand for crude oil and the like. And that makes perfect sense. The fact that I think the crude market's really interesting relative to, let's say, the stock market, because we haven't seen, there's been volatility below that 65 level. In some ways, when it actually had a 5 handle on it, you started saying to yourself, maybe this is the recession sign. Maybe this is the thing that's telling us that global growth is really slowing. And, as recently as this last week, we had the World Bank taking down global growth, across the board, saying that the U.S. is going to get hit harder. We had the OECD last week doing the same thing, right? And so it wasn't until the framework of a potential deal started coming that you saw crude break out. Now, this is 2.5 days in the making, right? So who knows? Like that downtrend from the January highs is interesting. The 65 level that's contending with right now is interesting. If the 200-day moving average guy was just a little lower, if it was like 67 or something like that ish, you know what I mean? I'd be saying, you know what? I'm going to sell this here. I'm going to sell for a move back below 65. I'm going to look for a play. The first stop would be sort of 60. So that's like 8-9% or something like that. And I would stop it right at that 200-day moving average. Because to your point, if you do get ahead of steam, if you do start having indications of growth kind of reaccelerating, then you're going to probably see some demand for crude. And maybe it gets back to those highs that we had in early April or late March, which kind of looks like 72-ish or something like that.
If Jacob can pull up a long-term Valero chart, and when I say long-term, a couple of years, VLO refiner made an all-time high, I think of April of last year. I want to say north of 180. Since then, it has been a series of lower lows, lower highs. But, if you want to sort of narrow the scope, so just make it a year and a half or 2 years so this gets a little cleaner. You could see this downtrend that we're either right up against if you want to draw a trend line from those highs, or, we're flirting with now. So we've either close to breaking out or we have broken out of this thing. So let's see. Now I would draw it even a little bit. Yeah, well, that's basically, you can see what I'm looking at here, Dan, right? So if you want to even tweak it, but this is one that could get pretty interesting pretty quickly, if all of a sudden crude oil becomes a story.
Yeah, and let's just pull up the Exxon on the flip side of that.
Yep.
It looks a little different, right? It hasn't, the same sort of lower highs that you're seeing. But this thing, for all intents and purposes, is pretty range bound between 125 and let's call it, 95 or something like that. So the large integrateds, where do they fall into this? Because yesterday when we saw crude, above 65, you saw the drillers were having a day. I saw Schlumberger or SLB, however it comes out, was up nearly 5% or something like that. And we know that there's a beta relative to, let's say, the large integrated. Like, is this a space? Carter was on with us on Monday on Market Call, and he was going through all the charts, all the sectors that have rebounded from the April lows. And he was talking about the lack of bounce that you saw in healthcare and in energy. And he was almost wanted to be contrarian a little bit on both of those sectors. And so, do you play it through the commodity or do you play it through some of the stocks? You highlighted, obviously Valero, and it's at a level, and maybe you play for a breakout. But Exxon, this is less clear. You know what I mean? Like, this doesn't seem like it has any direction right here.
Yeah. Exxon is, as you say, mired in no man's land, seemingly sideways now for a period of time. Valero may be a little more clear-cut in terms of potential breakout. And as we say all the time, not all energy stocks are created equal, but we wanted to highlight that because clearly something's going on. A lot of questions about gold, which is perfect because our next chart is in fact a gold chart. So let's take a look. Obviously, it's sort of not been doing all that much. We can draw this sort of pennant formation. I want to be crystal clear. I think you know where I stand on this entire thing. I think gold goes higher. You can make a case that on a day where, again, you have this announcement, gold should be lower than it is, and it's not. It's sort of hanging around. So I still think there's some room to the upside in the gold market here, Dan.
All right, so let's talk about gold. Let's go to the dollar for a second, the Dixie, the U.S. dollar index, okay? And I remember somebody once, without naming a name, and I can't remember what media. Well, I do remember what media was on, and you were making the case for gold, and you gave a bunch of like what you thought were fundamental reasons, and then you gave some role. You talked about central banks and this and whatever. Really nice thesis. I thought I don't know jack about gold, but I learned a lot by you. And somebody said, "Well, isn't it just the weakness in the dollar, guy?" You thought that was like a
Sarah did say that, yeah.
Oh, my wife Sarah with an H. You thought that was a bit glib. You know what I mean? Because there's a lot of other factors in play other than the weakness of the dollar. Is that fair to say?
Yeah, I mean, I don't think it's, again, look, I understand the role of reporters and journalists and anchors. I get it. The pushback and snarky. Listen, I've been in this world a long time, so I understand. But it's far more detailed and granular than just a weak dollar story. And I think that's been clear, by the way, for quite a long period of time. I mean, the dollar has been under pressure, but we've seen bounces in the dollar, pretty meaningful bounces where gold's hung in there. So I think there's been somewhat of a decoupling in terms of the import that the dollar has in gold. What it comes down to, I think, is central banks continue to hoard it in a way we've never seen historically. Obviously, the investing public continues to hoard it. And I think this has become the hedge, and I think the right hedge against central bank futility and, in my opinion, sort of, I don't know, incompetence, for lack of a better word. And it's not just me. David Einhorn was on with Scott Wapner from the Sohn conference a couple of weeks ago. He has been an outspoken gold bull now for a period of time, and he thinks it's going significantly higher than it is now. And as the aforementioned Paul Tudor Jones also talked about gold today. So the gold story to me is absolutely intact.
Yeah. And, that's one of the areas where, you think we talk about what's flashing red, like the disconnect between where the equity markets are and the valuations that are getting there. And what are the groups that are going to benefit from, kind of the lack of, I guess you'd say, headwinds, right? From, the worst case scenarios as far as, a protracted trade war. And I think that's where people are going to start getting to. Like, where are the areas? It could be on a macro level. It could be on the sector level. Where do you want to be? Like, where do you want to be if, growth is just a little better than expected, or it's just going to come in far worse than expected in the second half of the year? And I think a lot of folks are taking off the table a lot of those worst case scenarios for the economy, right? And so then you have to say to yourself, we just talked about, 225% years in the S&P 500. Almost every strategist was coming in. Nobody was that bullish again. So here we are. The S&P's up a couple percent. It's up 2-3%, right? If you look at it, I guess the S&P is up 3%. The NASDAQ's up nearly 5%. Man, how things have changed in not so long of a, you know what I mean? That sort of thing. So now I think you're seeing a lot of folks, they're getting rid of those targets that had a 5 handle for the S&P on it. And now you're going to start seeing 7 handles looking 12 months out. You know what I mean? So what works in that environment, I guess. But I think you would say, going back to the gold works in all of those environments because none of the problems are fixed as it relates to monetary policy.
I don't think they're fixed at all. I think they continue to get worse, and they continue to sort of paint themselves in this corner that it's very hard to get out of. And again, it's not, you don't have to listen to me. You should listen to people that are a lot smarter and a lot wealthier than I am, who have said similar and actually been more sort of effusive in their praise. So we'll see. We got a quick question in terms of Google, Dan. The Google PE and, dare I say, market cap is the best member of the Fateful Eight without question. What say you? This is from Scott Rogers. Now, we had a long conversation about Google last night. We've talked about the stock. There's clearly something going on. I've mentioned a number of times that a few months ago, an analyst compared Google to Eastman Kodak, which I thought was rather interesting in a word. They clearly have some existential risk here. And you've mentioned it. AI does not help Google in this world, at least not today.
Well, it should have, right? And that was one of the things I think that kept it in the penalty box for most of 2023 and into 24. And stock was trading very well into their Q4 print. This was in late January, and it was trading at an all-time high. And, relative to some of its peers, it was kind of underperforming. But, what's happened over the last 2 years is something, no shortage of a disappointment. Their ability to kind of take their own large language model and create a product like Gemini and roll it out and be competitive with OpenAI's and, some perplexities and some of these other things. But make no mistake about it, OpenAI is got a war chest like we've never seen by a company in the private markets. And they have access to compute that they're just, what they don't have, they're scurrying around to try to get. The headline today is that OpenAI, which is obviously a threat to Google's search business, they're actually going to be using Google, their cloud product, because they need more compute. So they are going to one of their biggest competitors to license or to license the compute on their cloud service. And that says all you need to know, that they actually feel so confident in their battle with Google, in my opinion. You know what I mean? And that could be proven to be wrong. But, they have a problem, not just because of like the way people are doing searches now. And I think that a lot changes once browsers are launched by OpenAI and by Perplexity, because Google Chrome, which is Google's browser, has like 80% market share or something like that. So I think there's a lot of headwinds here. There's also remedies from this FTC or DOJ case coming. So there seems to be more uncertainty in this name, not just the external stuff that we talk about all the time, but also the way that they have executed and operated. So I don't find Google particularly interesting here. I understand why people are going to want to pay for a catch up, especially if you look at the valuation, you see how much cheaper it is to some of their peers, but it's not for me right here, Guy.
I'm going to make a hard right turn and go into Chewy, and not necessarily, to trade Chewy, but to sort of think you wanted to highlight how you can have a good quarter, but if you don't say everything right, you're going to see moves like this. We're going to look at Lululemon as well, but walk us through why you think Chewy is important today.
Yeah, I mean, this is one, and I think that chart says a lot about it, Guy, is that this was a consumer stock that had been kind of working pretty decently, you know what I mean, off of the last summer sort of lows. And, you could say to yourself, like, this is a discretionary item. And a lot of folks would say, well, pets are not discretionary when you're buying stuff for them. I mean, people overspend there than they would on their own sort of discretionary items. And, you had this kind of breakout at a time where, lots of stocks in the market had not gotten up to their prior highs, right? 52-week or all-time high. And it just seemed like one of those kind of runaway things. And look at the low vol that it did that in. And so to have in 2.5 trading days to give up all of that breakout on a quarter that looked fine, you know what I mean? On a quarter where the commentary was the company saying we weren't seeing a lot of inflationary. They're talking about inputs to their own business or, inflationary costs, right? And to just give that all back on a decent quarter, I think it's noteworthy. You know what I mean? Like, I think you want to pay attention in the consumer space. And it kind of goes back to, and there's no comparison here, but Costco, disappointing comps a week and a half ago, had a bad couple of days for that. That's not something you see. Obviously, Lulu last week was down 20% in one day. Very discretionary. Are they having, problems with inflation and problems with, the potential for a trade war and all that sort of stuff, but they're executing. They have higher competition, and that's not an expensive stock anymore. So I just think there's like a mosaic that could be kind of put together for consumer discretionary that's not great, even if we have a tamped down trade war situation.
Yeah, I mean, throw a little Lululemon up real quick and do a longer term chart. We're pushing down against levels that have been support. I mean, you can draw that horizontal line across the bottoms, and you'll see what I'm looking at here. Jeff Mackey used to say, and he was right when he said it then, and I think it's still true today, specialty retail, which Lululemon is where hope goes to die. And you're on the other side right now in terms of Lululemon of growth, and you're on the other side of having no competition. Now all you have is competition. So maybe the product's still great, but in terms of the stock, I mean, their best days, I think, may be long behind them. Now, we're at levels of where it should bounce from here. If you want to do a shorter term chart, I think those bottoms look a lot clearer, but there's obviously something going on here in terms of the problems Lululemon is facing.
Yeah, I mean, but some of these kind of, fashion sort of, this was an area where for 10 years we've been hearing about $100 yoga pants and how ridiculous that is. And Gap launches Fablets or Fabletics or whatever the hell it is, and they're half the price. And, I guess let's back it out to 5 years. It's like this was always trading at a premium valuation, even relative to, let's say, a Nike, but like that volatility that you've seen over those years, what is that on the upside? $500, and on the downside, it's what, 250-ish or something like that. There's plenty of room to make money now, but back this out for 10 years. Now, this stock trades at 17 times earnings, and yeah, there's not a whole heck of a lot of growth, mid-single digits or something like that. You could say, well, why shouldn't this go back to its COVID lows? And you look at that all the way back there. That's the trick here. You could also look at this and say, technically, that's a massive head and shoulders-ish sort of level here. So, figure out I look at that pre-COVID high, Guy, and we're kind of right back there in a way. These are really important technical levels. Maybe it's the sort of thing that you play with, call calendars or call spreads or something like that. Nothing's going to happen the here and now. But, a play back towards 350 or something like that in the not so distant future, if you kind of get some things right on the macro and then maybe on the micro, it could start looking interesting to me, first on valuation, but also on a sentiment standpoint.
But real quick, we have a poll out in terms of the S&P. New highs coming or epic failure? Right now, Dan, it's 60-40. I'll let you guess. 60% thinks what?
New highs, obviously.
Yeah, you are obvi. So vote in the poll.
Yeah, who knows? I mean, I don't know. I mean, one thing I'll just say is I've been bearish on what I think is going to happen in the economy. Not an economist, not even a good strategist, that sort of thing. I just kind of anecdotally, I look around and I say to myself, the housing market is not freeing up anytime soon. We just, and that's really important to me about the domestic economy here. Unless that, we heard some some stuff about HELOCs and people taking home equities, and that should be good. And then you have the tax and everything like that. I just feel like, the tax bill is not going to be the sort of thing that does it for the economy. We also know that when people get those tax cuts, they don't just go out there and start spending and buying houses and this and that, or whatever. So I'm just less optimistic about this sort of thing. So when I think about the stock market, yeah, I thought that we should pull back. Yeah, I thought we should kind of fill in that gap from early May, the big Switzerland deal, you know what I mean, that we had on trade. But it just doesn't feel like it wants to. So until wake me up when it kind of tests that 200-day moving average, which is where it was a month ago. And then we might start talking about what's in for the market on the downside.
I'm about to ask for a picture that I find troubling. Well, more than troubling, but it's emblematic of where we've become and where we're going to as a society. So, Jacob, please put up this Financial Times article about Snapchat and this new product launch, because, again, this is what people seemingly want. Dan?
Well, if you look at Snapchat, let's pull up the stock for a second. All right.
We'll leave the glasses for, oh, my God.
Oh, well, there you go.
Geez.
Okay, so Evan Spiegel started this company. It was all the rage. Let's be clear. Okay. What they were doing, taking pictures of your faces, you're 14 years old, you send it to your kid or your friend.
It's so much fun.
Keep a streak going. Like, let me tell you something. Ask the Lulsters. Okay. Like, she is your grown daughter here. She grew up on Snapchat on an iPhone. I'll bet you she's still keeping streaks up with friends, sending like literally just pictures of themselves. I don't know what the hell they do. I don't know how they monetize it. If you go look at, that's a static chart. Go look at like a 5-year chart of this thing. It was a COVID darling, but this thing has been an absolute dog. You know what I mean? Other than take COVID out of there. Now you'd say to yourself, okay, what are they going to do? What's next? All right, let's go back to the other chart with Evan Spiegel, the founder and CEO of this company, who, by the way, has super voting rights. That's next. That's what's going to happen. Their AR, VR glasses, like those are the worst looking things. The stock's up today because they just announced that this is going to come out next year. By next year, these things are going to be obsolete, in my opinion. The way in which, Meta. Oh, wait, hold on a second. What's right here? These are my Meta AI Ray-Ban glasses. Okay, and now I'm filming us. I'll put this on the interweb right here, and this is going straight to my iPhone. I have a Meta AI app. You know what I mean? These things cost, $300. That's not a cheap sort of thing, but I look great in them. And they're just Ray-Bans. They're transitions that go outside. They work as sunglasses. They'll turn into sunglasses when UV rays hit them. Snapchat is just Snap, whatever the hell you want to call it. They are just so far from the mark here. And I just don't think hardware is the answer for this company. You know what I mean? So again, I want to say, oh man, this thing looks washed out. You should buy it. They got a good balance sheet, yada, yada, yada. I just don't know how they get back to growth. So that's it, guy. That's what I got for you.
There are a few things you said there that I will choose just to sort of look and look past. I look great in them, and they're just Ray-Bans. No, they're not. They're sunglasses with a little flashing light that appears when you're filming people. It's not for you, guy. It's not.
But
nor is these glasses that this Johnson is wearing. At least, if you go back to the prior picture, Jacob, quickly before we get to Butters, at least these fellas are wearing nice suits with ties.
Yeah, you know who's in the middle there? That's Emmanuel Macron. That's Emmanuel Macron. And by the way, I think he had those knocked off his face by somebody a couple weeks ago, but whatever. We'll leave that for another program.
Maybe his wife.
All right. Yeah. You saw that, right? You saw that she smacked the shit out of him. That was absolutely amazing.
Yeah, whatever. I mean,
listen, I say this all the time. In every relationship, someone has hand. That means the upper hand. In this one, it was very clear who had the upper hand. It was his wife, who's
nobody should have an upper hand. It should be a level playing field.
Yeah, good luck with that. All right, let's do this, because if it's Wednesday, guy, it's Butters. John Butters, he's the senior earnings analyst over there at FactSet. He writes the Earnings Insight blog. It drops every Friday morning. You can have it in your email box. Jacob, where might somebody find this? Right there, factset.com/insight/subscribe. All right, this is what Butters is talking about this week, guy. This is going to be near and dear to your heart. The term inflation has been cited on the Q1 2025 earnings calls of 227 S&P 500 companies to date. The number is below the 5-year average of 254, but above the 10-year average of 189. How is it below the 5-year average, Guy Adami?
Well, there's obviously, as the numbers have come down, and with each seemingly month we get a little bit better data, I mean, people are seemingly less and less concerned with the problems that inflation is having on their businesses, which I get. It's sort of in the rearview mirror now, but it doesn't, this is just me, it doesn't mean that inflation is still not a problem for the consumer at large. And one has to wonder again how the consumer is going to sort of get themselves out of this problem that they're facing in terms of, and you said it earlier, but fighting inflation with credit. I mean, that has not gone away. As a matter of fact, that continues, at least the numbers I look at, to grow every month. So I get that companies are citing it less, although still above the 10-year average. This all makes sense to me, but I don't think it means the problem is going away.
Yeah, and so Butters also mentions the number is also consistent with the numbers reported for the previous 2 quarters. It was 229, 228. The industrials, 46 of them, and financials, 40 of them. Sectors have the highest number of S&P 500 companies citing inflation on earnings calls, which I think might have to do with like their consumer exposure, at least on the financials. Obviously, industrials input costs are really important and where they come from and the like. However, the consumer staples, 85%, and materials, 81% sectors have the highest percentage of S&P 500 companies citing inflation on earnings calls. Does that make sense to you?
No, yes, it definitely makes sense. Now, you know, as companies sort of put this in the rearview mirror, one has to wonder if it's going to sort of rear its ugly head yet again. And going back to how we started this show, you know, Paul Tudor Jones seems to think it's still a bit of a problem. So, you know, this can be sort of backward looking in terms of what companies are worried about, but it doesn't mean it's still not hanging around there in the ether. And, you know, I don't think the inflation story is going away anytime soon.
You know who else doesn't think that? Our main man, Doug Cass, who writes at thestreetpro.com and also the manager of the Seabreeze Capital. He sent us this note just a couple minutes ago, Guy. Based on the recent swings in the trade balance, importers likely stockpiled product ahead of Liberation Day, so they had goods to sell without being subject to tariff penalty. When the inventory is sold out and runs out, price hikes are likely, producing hotter inflation reads in the second half of the year. That makes a lot of sense. He is one of very few people highlighting that here, Guy.
Doug, we say it all the time, almost on a daily basis, how thoughtful his work is. We'll say it again today. I mean, yeah, and I agree with him. And I understand that's non-consensus, and I understand that people are tired of hearing about it, and to a certain extent, the market's tired of hearing about it. But ask yourself this question, and I think the TLT is sort of unchanged today. Dan, let me just take a look real quick just to make sure before I say anything. It's actually slightly lower. If I had told you again that this inflation data would come in, you know, softer than expected, you would have said that TLT is going to rally today. And at least right now it's not, which leads me to believe that higher rates are still going to happen for a myriad of different reasons, not least of which this inflation problem still being sort of out there in the wilderness somewhere.
Yeah, no doubt. I mean, it's hard to make the case right now, Guy. And, you know, when you have like softer than expected CPI and the like, and you have, you know, the 10-year down 3 basis points. But I think the reasons that you cite are things that are not on people's bingo card. And I think that's the most important point. And that's, I think, how we can add some value, because it takes 2 to tango. And that's what makes a market. I know you love all of those sorts of.
I love those things.
All right,
Bill, I heard Bill was great last night. Good for you, Bill. Yankees took care of business in Kansas City. But the thing that's troubling me the most is the Mets don't friggin' lose.
Yeah, they don't. All right. So if you liked what we just detailed, John Butters, senior earnings analyst at FactSet, he writes the Earnings Insight blog. It drops every Friday morning. You can have it in your email box, Guy. You could go to factset.com/insight/subscribe. All right. Thanks, Butters. Guy, are we out of here? Is that it? We covered a lot.
I believe so. I mean, I will be on CNBC's Fast Money later today. You will not, but you have a sit down that you're doing, I think, in a little while.
Yeah, so I have a guy named Rishi Jalaria. He's a software analyst over at RBC Capital. They are a fine sponsor of our Risk Reversal podcast. But Rishi's a really good analyst. I really enjoy talking to him. I follow his work, and we're going to break down what's going on. Oracle is today after the close, so he's going to be here, and we're going to talk a little bit about Oracle, Adobe, Salesforce, some of these other names, and how they're playing in this generative AI space. Who's got the goods and who doesn't? So that drops tomorrow morning in the Risk Reversal podcast feed. You and I are back tomorrow morning at 11 a.m. right here on the Market Call.
Vote in the poll, people. We look forward to hearing and seeing the results. We'll see you later.
See ya. Thanks.